for example, the family-owned business, it's a family owns, say, 40%, 50%, 6%. It's a company. It's a family-controlled company. Typical case. So as a founder's age could be somewhere 70, 80. So, obviously there must be this kind of generation change. Second generation of founders in around 40 years old, in 40s, around 50 years old. Typically, they are educated in the States. They tend to speak good English. So, second generation people naturally will want to change their own businesses. That's a typical case. Also, that's Japan is now a very much mature economy. So we don't see that the strong demands, domestic demand. But still, our manufacturing capability is good. So its quality of manufacturing is good. So by looking at the opportunities of such Japan, even for small companies, they'll see that growing demand. So second generation people can speak English. For those people, having a kind of alliance with European companies, Chinese companies, US companies won't be a problem. So these changes are happening every day. Also, it's a little different case, but there are a number of companies which are subsidiaries of large corporations. Okay, so the Hitachi group of companies, there are a number of listed companies with a Hitachi group of companies. Holding company Hitachi controls all those subsidiaries. Hitachi owns maybe 50% in the company, remaining 50% floated on this stock exchange. That's a typical case. But now these subsidiaries are relatively small companies. Okay, again, these stocks can be extremely cheap because these companies are controlled by large corporations. Lack of governance is always an issue. No exit scenario. But those big companies, Hitachi, for example, are buying. They changed the whole group structure. So they're acquiring these subsidiaries. The delisting is going on. So now you have an exit. You buy into these subsidiaries. Historically, no exit at all. So kind of so-called value trap. These stocks are cheap, but will remain cheap because of no exit, lack of governance. But now, parent companies buying back shares, floated shares in these companies. So you have like an exit. So again, this restructuring is going on.
Why are in this case, why is Hitachi buying shares back in its
strength and control, whole group control? Because these different organization listed on the stock exchange. Now that is 100% owned subsidiaries of Hitachi. Hitachi controlled can take full control in these companies. So better governance.
But are there premiums being paid to
But-
get that
but-
full control?
Premiums are not so expensive because these stocks are extremely cheap. Because cheap stocks is say paying that's a 30% premium on cheap stocks won't be expensive at all. Say fair value to be 100, trade 50, you pay 30% premium, maybe you buy back at 65. Still cheap.